cautious on. I think Florida's one, there's a lot of stuff going on, being a little cautious with that. Some of the Gulf Coast areas maybe a little bit concerned just with insurance and a few things, and Chicago is also a tough one a little bit, so trying to be cautious in those spots.
Okay, appreciate that. Well, that was a question further down my list, which was giving your current perspective on the development market, and have you been surprised by the number of new developments you've become aware of in a specific market or two? So you just referenced Florida. We both talked about Florida, but obviously it's the pockets, right, that can make sense. Anyone else have any other markets where they become a little bit concerned just hearing about new developments?
Well, we're always concerned when we see a lot of entrance into the market. But it's like the old saying, if your neighbor loses his job, it's recession. If you lose your job, it's depression. And if another facility gets built in your city or your marketplace, it's probably not that big a deal, but when they locate across the street, it is a big deal. And I think there's still far too many of those kinds of things going on out there. And I think that it's really time for folks to get realistic about where market rates are going, what absorption is looking like. And let's face it, we've gone through a cycle where cap rates in tertiary and suburban markets were almost equal with those in urban gateway cities. And our thesis right now is that the suburban markets are not holding up as well, and typically don't hold up as well in downturns as they do when everything's booming. And I think that is tied back around to the amount of demand that is contingent upon transition in house movement. And we simply see a lot more of that in the suburbs and in tertiary and secondary cities than you do in gateway cities. So, core New York, Miami, Chicago, even areas that have lots of lifestyle users, we're kind of a little more interested in right now after having chased tertiary and secondary markets for the last 7 years. So, we're going where we perceive the most defensible strategies so far.
Interesting, Brian?
Jim, I think you started talking about kind of the new construction fears, and I think a lot of us have short-term memories. 2019, we were probably all on stage talking about how we're scared about new supply. Now, you see Green Street's report, and they say, new stock's going to be about 3%. Now, I'd probably argue it's greater than 3%, and they're not factoring in all the millions and millions of square feet of expansions that are being done, a lot of the scraping that some big public companies have. You just saw about 70% of the room raise their hand, saying they have new development, so that doesn't seem like 3%, that seems more like 70%. So, I think the concern is still that new supply is coming, and when you look at some of the public companies, CubeSmart has 30% or having at least one new store in each one of their assets. So there's definitely a concern for new supply that will, with some of the weakening fundamentals, is a concern.
So how many of you have had more than one developer come to you maybe that isn't as well capitalized, that doesn't have patient long-term capital, thought they were going to do the development themselves, but now they're looking for help to come into a development opportunity?
Absolutely, we're seeing a lot of opportunities like that, acting on very few, but certainly seeing them. And it's not just from the equity standpoint, it's also from the debt. Folks that don't have a long-term relationship lender, it's tough. Even when you have a long-term relationship lender, it's tough. Just that we see the fundamentals overall weakening, and as a result of that, we're interested in new development and new deals as they come around. We just don't see very many folks that have realistic rent-up assumptions, realistic unit mixes, and realistic market rate assumptions. And, it's not 2021. We were blessed with a period of time where for 12 or 14 months, nobody moved out, okay? And we saw run-ups, occur, 18-month run-ups, things like that in new facilities. And that's the kind of thing that you see performance submitted to you on. You look at it and just, you make no choice but to shake your head and tell the folks that, they really need to readjust their expectations.
Yeah, that's a good point, Chris, because we're seeing Talinvest right now is doing more construction loans than we've ever done. However, as you just stated, the leverage is much lower. The interest rate is significantly higher. And part of the process now has been working with owners who may have underwritten pro formas 12 months ago, and now the world has changed, and they are looking for ways to bridge that gap, that equity gap, on top of the debt, because the debt's become lower. So I think that there's a lot of hands out there, but I think it's going to be much more difficult in the construction lending side. Even if you have an existing relationship, there's more recourse, and they want deposits. As Robert Kaplan said, these banks need to fill the depositories. So it's going to be, I don't know that as many of these properties are going to come to completion.
Well,
After Mr. Kaplan spoke, I don't know if anybody's built anything.
just staying on top of that, the underwriting of a construction loan is just harder to fess up. Usually there's a development yield, which is 150 to 200 basis points higher than the cap rates. And the cap rate is, as we all know, has moved up at least 1% from where it was 12, 18 months ago. And there's so many unknowns when you look to figure out the dynamics of a construction loan. There's the absorption, there's the rental rates, there's the cost of construction. You have to get it all right. And so you add all these factors of trying to figure out what the pro forma looks like and the target NOI at the end of the day. Where lenders, on a construction loan, they want a takeout loan. They want to be able to make sure that it pencils out when it's stabilized and that, there's permanent financing behind it. So when you take into effect the tighter credit markets, all the assumptions that go into it, the additional costs, it's just, we see people coming to us wanting construction loans that we just, quite frankly, say they don't pencil out and have those conversations with our borrowers. We are doing some construction lending, but it's way down from where it was.
And what's different now, reminds me of the old days, the cost of carry on a development has suddenly become a real factor. That shortfall over the 48 months it's going to take to lease up can just be a killer at 8 or 9%. That at 3%, it just wasn't that big a deal. And if you make a mistake now, you have to end up hitting your hip to feed that beast during a protracted run-up. It gets ugly. And you better make sure you have a significant cash reserve to be able to handle that.
Excellent points. Noah, given that on July 20th, you did complete the largest acquisition in the history of the storage sector, $11.6 billion, do you have a guess as to when you may actually gear up an acquisitions effort again in future?
I think it took Wooly like 40 hours before he was ready to do another deal. So, he was pretty quick and he's always excited to do more deals. But for Extra Space right now, it's really about kind of swallowing what we've bitten off, right? And it's important that we can operate that, not just for ourselves, but for our investors, for everyone, that's operating store. If we go back to operations right now and say, hey, we're gonna have another huge opportunity, probably not in the cards for us. Now, that being said, we're still going to do management, we're still going to do loans, we're still going to be doing, buying what we normally do, those regular deals, but probably not something massive for a while.
Understand. So Chris, Brian, and of course, Noah will certainly want to hear more from you, but, you know, can you provide kind of an overview of your investment and growth strategy as you see it today in this market, next 12 to 24 months, and maybe very briefly contrast that with what you've been doing the last 12 to 24 months?
So I'll kick it off. Let me go backwards and then I'll go forwards. So last 12 months was probably one of our slowest periods in the past 5 years. We've only acquired 13 properties. Previous to that, the previous 12 months before that, we bought 45 assets. Kind of go forward from here, we see ourselves as probably the next 12 months. The majority of our investing is going to be either buying loans or originating loans. So we'll still be doing equity deals, but we see those as, you know, few and far between. And we think that has a pretty long runway for the next couple of years. But we hope then, as we start seeing liquidity in the markets, funds that are not going to want to hit the cap calls, that are going to hit from like 24 and 25 because they're going to have rolling maturities. We think there's going to be a lot of liquidity, a lot of people that are going to have to sell, and because they're going to have debt covenants, they're going to have regional banks that can't extend anymore because the pretend and extend days of 09 are not really here today because these regional banks are pretty imbalanced, especially on construction loans. So we think that's going to have a lot of opportunity in the following 12 months.
We're seeing that, and we were talking about this, Brian, there are a lot of bridge loans that were done maybe 18, 24 months ago, and they bought a 2-year cap on a 3-year term, and those caps are expiring in the market today. And there's another that's outside of the covenants, that's outside of the interest rates. That's just buying another cap, which can be expensive. And if you don't have the capital to pay it down, then you got to look at alternatives, which may be to sell, or that note gets sold prior to this situation occurring, which is maybe some distress. I know we haven't talked about that in a while, but there might be some distress.
Well, this is kind of code, right? So after listening to Penner talk about, you know, he wants to buy the debt, and Brian, the same thing, that's code for, I can buy you cheaper by buying your debt and foreclosing on you than I'm going to be able to buy you in the open market, which is a little bit chilling, but that's the cycle that we're heading towards. And I will tell you that we're interested in doing the same thing. There is still, well, you know, there are lots of banks out there that need to clear up their balance sheets, and they want to move these notes.
Right.
I have investors that, you know, if I needed $1 billion, you know, tomorrow, I could probably get it if the return levels justify it. So, you know, we find ourselves in a position where we're very well capitalized and we have lots of money to play with, but very few opportunities that pencil out and make sense. So we underwrite, you know, I don't even know what we underwrite, billions of dollars worth of deals a year to do a handful. And acquisitions have largely dried up. That's probably a function of fundamental mismatched expectations between sellers and what buyers can currently pay. And that's going to continue for a little while until some events start to occur, as Brian and Eric intimated. You know, you got a 3-year deal with a cap on it, and your cap's expiring. Maybe you've got a 1+1 extension, but to be able to take advantage of that, you got to go out and buy a new cap. Guess what? That's really, really expensive. And if you're not prepared to pony up and recapitalize your deal, you might not be able to hang on to it. But if you look at it from just the acquisition market, you know, I don't know, I've only been doing this for 37 years, so.
That's not long enough.
But I can't remember a time when the expectation of cap rate obtained was significantly, let me make sure I'm getting this straight. where the expectation of cap rate was lower than the cost of debt. Okay? So literally, if someone like me can only go out and borrow money at say 8%, how on earth can I go through and pay anyone a 7 cap? Okay? But we're not seeing a lot of properties traded at 7 cap right now, are we?
No.
You know, so we're all expecting to grow our way out of that, right? So that we're thinking rates are going to go down, or NOI growth is going to be good enough to grow it out, so that after about a year or maybe 2, I'm in a positive relationship to my debt yield, and therefore I can justify doing a deal. Well, I got to tell you, we're all seeing NOI growth slow. You know, by Q4 of this year, the industry could well see 0% growth rates among some of the REITs. Could start heading towards negative territory. So where's the growth? And what the first 2 speakers talked about was repricing of risk. And that's exactly what this is. We got to reprice the risk, because right now we can't pay, given the cost of what we have to pay our investors and what we borrow money at. We simply cannot pay those whopping low cap rates that everybody saw over the last 3 years.
So one of the questions
Well,
that,
first of all, I wanted to give Brian an opportunity. I know you wanted to respond to something Chris said about getting in on the lending side. Not that this is turning into the Republican debate, but go ahead, Brian.
No, I just wanted to make it clear, our goal is to buy loans and originate loans, because of the yield. So we see the credit yields are just more attractive than the equity yields until sellers and buyers really can meet. And obviously there's some buyers out there that are still buying at cap rates that seem to not make sense, as Chris was just saying, but we can delve into that a little bit.
Well, there's, I was just looking at the pie chart here. 40% of all outstanding debt is from banks, and 14% is from regional banks. So, talking about situations with the banks and having to solve for their issues, it's leading down the path of possibly loan sales.
If this is the Republican debate, open mouth, looking like Chris Christie.
You got that.
Is that what it is? Just want to say, to follow up what Chris said, we're not the REIT that's projecting negative revenue growth.
I'm glad you said it, because I was going to follow up with that.
Yeah, he might be providing guidance for his company, for us, we're not. But, we've given guidance where we are, and well, it's not negative. It is less than what it was, right? I think we're all seeing that. We're seeing it mostly on the rate side. I think everyone's kind of experiencing that. The occupancy is still holding, but you have kind of 2 levers. You're either in the occupancy side or you're in the rate side. And so we take a little bit on the rate side, held occupancy stronger. Again, as the previous speaker said, I think that we're still in a good asset class, and things are still really pretty strong relative to a lot of other real estate things. But I think people are used to what it was in the last few years. It doesn't feel as good as it did.
Well, so Neil, you started to say something when I wanted to give Brian a chance.
yeah, no, it's great to be part of the Republican debate here. I'll take the contrarian a little bit, in the sense of we've had other cycles where I would say asked many times, when are the note sales coming? When are the note sales coming? And in this industry, in self-storage, I haven't, in my 30 years, haven't seen a lot of note sales in self-storage.
But have you seen rates go up this fast in such a short amount of time?
What I have seen us being the prettiest, ugliest person in the asset class, as was mentioned earlier. And I think there's bigger problems in asset classes that have much larger issues than self-storage. If you look at office, for example, the borrowers, they don't want their assets. The lenders don't want the assets. The lenders don't even want to take them back in many cases. I think self-storage is a very different animal, where even if we're looking at a 15 to 20% decrease of some assets, that there's still valuations that could be made, and from an owner standpoint, they have the ability to get debt or recapitalize at higher rates. They have equity that they can put in, and they could sell before and either break even or get something back before it ever gets back to the bank. So I still don't see a lot of note sales. I don't see it happening in our asset class.
So gentlemen, we know the state of the acquisitions market right now. When do you believe the acquisition market will begin to come back, and why? And what needs to happen before this occurs, in your opinion?
You have a mismatch between where rates are, where you can borrow, and where people are willing to sell, right? So just like Chris said, if you're gonna end up with that, right now it's a mismatch, it's gonna be pretty tough. I think you're gonna have to have a realization of sellers, you're gonna have to start seeing cost of capital change for people to be able to buy differently. I think right now, it's like everyone's saying up here, everyone's looking for better opportunities with either note sales or distressed sales or something like that. If we start to see that, maybe those things come up, but I think right now it's probably gonna be a little bit of time before we see anything major happen. Now, there are still things, right? I mean, we just obviously did a big deal, there's still stuff happening. Right. Publix just did a big deal. There's still stuff happening. It just doesn't feel like it did a few years ago. I think we need to reset our minds that it's not 2020, right? That was a whole different world. You look back and say, what was it like in 2017 and 18 and 19 when the world was kind of a little more normal than it was between 2020 and 2022 and a half.
Just to follow on what Nellie was saying, I think sellers, and Ethan kind of said it, but sellers need to realize that a year and a half ago, their assets were worth a lot more. Now, the question is what's more, and what we're seeing from the brokers, guidance is, we're coming in probably 30% less than guidance. And I think the sellers in their mind they think their properties are worth 20 to 30% more, but from cap rate expansion alone, you kind of lost with where rates are, and if you believe rates are going to be here for kind of the foreseeable future, you've lost 20% of value on your property just from cap rate expansion. Then you couple that with the fact that now you have move-in rents going, decreasing, double digits. You have no mobility in the economy, so that's a big factor in self-storage. So that will, that'll continue to decrease the amount of demand for move-ins. You have certain expenses accelerating, like real estate taxes, insurance. I mean, I'm sure everyone's got the headline between the mountain states, Texas, Florida, California. So insurance expenses are going away. So, in reality, sellers need to get in their mind that their values are worth 30% less. So when I think that comes together, then you start seeing more acquisitions move.
So that's why he's buying loans.
So do you think interest rates have to start declining before that happens?
No, I think liquidity is going to be natural because there are going to be funds that have to sell. And like I said, there are going to be, one thing I would disagree with Neil that I think is different this go around is the banks have to be in balance. They don't have the deposits. So they have to, it's not that the assets are distressed. Self-storage is fine. It's that the loans have to clear. And so and by the way, we bought more assets via loans this year than we have bought assets. So, it's just that there is, I think rates, everyone needs to have clear guidance that rates are going to kind of stay here and that the Fed's not going to increase. And that we're not going to see the, $1.9 trillion flowing into the economy still create an inflationary environment. When people feel that's settled in, then I think everyone's going to feel better about buying.
What we need to really get the acquisition market cooking again, though, is organic growth in our base assets. And we simply need to see stronger occupancies, stronger rent growth, and we're not seeing it right now. We are heavily correlated to the housing industry. That is, I always look at it as a three-legged stool between our commercial accounts, our lifestyle accounts, and our transition people. And our people in transition simply are not moving right now. And until that winds its way out, our industry is going to do fair. Okay, it's not going to be great. We might end up being the best real estate class that's out there, but again, it's just not going to be great. So we need to see some growth either from our commercial tenants or from our transition business keeping in place again. When we see outsized NOI growth that allows us all to be able to pay more, values to go up, et cetera, et cetera. It's a virtual, environment if we can get there. The question is, when are we going to get there? Perhaps sellers in our marketplace are going to reconcile themselves to lower valuations, just as people who are sitting on a 3% mortgage, but it's just time for them to move on and do something else. So they start heading towards market and perhaps transacting as they simply become adjusted to the new normal. I really don't know how it's all going to play out, but I think it's tough to go through and say that everyone's storage facilities, say 12 to 18 months from now, are going to be worth significantly more than they are now.
Well, I think a lot of people are here because we all as an industry want to find out what the price discovery point is, something that we all in this room want to talk about. And it's simply not there yet. So if the Fed stops increasing, bumping, which it sounds like they're supposed to, there's always a gap between buyer and seller, no matter what market. There's always a gap. And there'll always continue to be a gap. And I think part of the buying over the last 2-3 years is buying the dream, whether it's automation or increased NOI, increased revenue management. A lot of those things are stabilizing, right? And we're seeing the opposite happen now. Insurance costs and real estate taxes and occupancy levels going down, street rates are going down. So it's not that easy anymore to buy into the dream going forward. So maybe that narrows the gap between buyer and seller. And then when you had one of the questions, I'm going to go ahead a little bit. One of your questions that we kind of talked about was how much has the last 2 years helped our industry. So I did some calculating, and if you were at 15% increase NOI year over year from the last 2.5 years, you're at break even in terms of if you were able to get new financing today. Anything else, if you're at zero, if you're even and you're not increasing your NOI, your borrowing power has gone down 25%, which is your equity. So as loans become due, there is going to be stress, and that is going to force more sales.
One thing that Kaplan said that I thought really rang true is, what about Plan B? We all are hoping and praying that rates are going to come down significantly over the next kind of 3 quarters, but what if they don't? Okay, and what does that do to your investment? What does that do to your refi plan? What does it do to your forecasts, et cetera? And I think stress testing your balance sheet, your cash flow over the next, say, 12 months is going to be particularly important, just in case.
Great points. Appreciate it. How would you contrast the current public market with the private self-storage market today? Who wants to take that? Brian, you want to start?
I'll start. Look, if I wasn't long self-storage, I'd start buying publics right now, because I would think is probably the best operated public company. Actually, they're trading at low 6s right now. So the private markets are clearing at high 4s or 5%. So you got anywhere from like low 6s up into the 7s, which would seem like a good investment. But in reality, I think the private markets are a little bit mismarked where some people are buying, and I think they're buying too aggressively based on
where interest rates are.
Historically, where we are relative to where stock prices are, it's a little bit low. It's interesting to see where it is. I mean, it depends on where growth is, where that comes from. It's all about where rates are, but what growth opportunities are out there.
Chris?
Yeah, one of the things about being in a public company is you have to constantly be, any company, you have to be looking at your cost of capital. Right now, had you all not done an all-stock deal, the idea of doing that as a cash deal would probably have been incredibly unpalatable, simply because you'd have to borrow, you have to go to the market and raise a bunch of money. And I would imagine you all don't want to issue a lot of equity at your current share price.
We wouldn't, right now, we're not issuing equity, it makes no sense. The debt for us right now, we've done a few bonds in the last 6 months. It's somewhere between 5.5% and 6% we'll be able to raise, right? That's pretty good. It's higher cost with our weighted average cost of capital. We can't just take it all debt. We're not just doing all debt deals. With the cost of equity in there, it still is, you have to look at it and say, what makes the most sense relative to where cap rates are. You can still find deals, but it's still tough.
Whereas on the private side, we have a higher cost of capital than the REITs do. Yet we're still out there, doing deals when we see them as being accretive. I think the difference is in the public venue, you're under the microscope all the time, and you don't get rewarded for running out your lines of credit and borrowing a bunch of money that the market knows you're going to have to raise expensive equity with to pay off. So if you're a REIT CEO right now, it makes no sense at all to go out and do a whole bunch of deals unless you can use your stock as currency. That always is a relatively good deal. Of course, you have to be careful there too in terms of overall cost of capital. So I think the private market will be a little healthier than what the public guys are going to be doing for a brief time. And then as soon as the industry kicks off again, the public guys always have, the advantage of jump ball always goes to the public guys when it comes to the cost of capital. It's very tough.
Jim, something else I think is important is you have to look at why people are doing certain deals. If it's for developer fees, it's a whole different deal. It doesn't really matter what it costs or what it is. If you can make a couple bucks by doing that, it's a whole different thing. If you're doing that with a JV partner and their cost of capital is very different, that might be a whole different reason why you're doing that too. If you're doing it for AUM, you might be doing that just to pull it in to collect fees on that. And so I think you have to look at every specific deal and say, what's the strategy behind it? I don't think we can assume that every in here is buy and hold forever or buy and hold with their own equity. And that's changed a lot in the last 10 years in stores. It used to be that people were, raising money, friends and family put it in, dollars, hold it, manage it themselves or find someone to manage it. That's not the case anymore. There's a lot of different reasons why people are doing it. And I think that changes the market too.
Are you implying maybe that there's some newer equity investors to the sector that have been willing to push the envelope a little bit more and look at lower returns?
Yeah, I think that we've seen that in the last little while, right? You've seen that with funds coming in. I remember, 15, 18 years ago, we were trying to raise money from the large banks and large, other large financial institutions out there that now are knocking on our doors saying, please, we'd love to give you money. And you don't really want it, you don't really need it. We've used a lot of JV partners. It's been very beneficial for us. And there's been a lot of money that tried to get in. Sometimes pricing different deals at different prices than they should be made because of what that cost of capital is. But we've seen a lot of different vehicles being used. And as you've seen non-traded REITs, you've seen SPACs, you've seen JVs, you've seen a lot of stuff that's trying to come into this. You got to look at it and say, what's the motive behind it based on what the capital is trying to do.
How about for our advisors here? Give an example of the profile of a lender and what just the basic, real quickly, terms were on a bridge loan or a permanent loan that still met the needs of the borrower in this market here over the last several months. Eric, you want to go ahead?
Sure. Well, it's met the needs. They may not have been overly excited about the terms. But really what we've seen is going into a different kind of class of lender has kind of been the way we've been executing on debt over the last few months, meaning, as I just said, 40% of loans outstanding are with banks. We walk through their issues. As Ethan Penner said, CMBS, don't do a loan. Well, actually, their volume is the lowest it's been since the Great Recession. So life companies really were filling the gap for the last few months. Now they run out of allocations, so that will probably become sparse.
And as we get closer to the end of the year, they run out.
They'll run out of allocations. And they're very picky. So if you had a low leverage loan request in a urban infill location and the deal was large enough, I mean, they were still doing loans that were around 6% fixed, which was good. On the bridge loan side, you basically had some credit unions who would come in and look at deals, and some life companies that would look at deals that maybe were 30 or 40% occupied, maybe 50%. And a borrower who said, I really don't want the floating rate today because the SOFR floating rate is about 1% to 1.5% higher than maybe a 3 to 5 year fixed rate. So some of the groups, life companies, credit unions have come up with this product that will fill that gap. So we've done a lot of that, but it's not an all-encompassing solution. It's a credit union in a particular part of the country, a smaller life company that will be in the self-storage space. So, I think it gets a little worse before it gets better in terms of capital that will be available.
Neil?
Well, I think what Eric is saying is that we have to work harder these days.
Yeah.
And you have to be creative, and the banks are not the same as they used to be. They're tightening of capital. When you talk about Ethan Penner saying that the Fed is controlling what's happening in the capital markets, I think the regulators have a little bit to say in that too. And if you look at the four large banks, the JP Morgans and the Wells Fargos and the cities, they're not lending in commercial real estate. If you look at the next 20 lenders under them, the money center banks, they have regulators up and down their throats, and they're pretty tight too. So it's the smaller regional local banks, it's credit unions that are actually selectively lending today. And when you go to that market, they are lending against what is available in their portfolio or their funds, and they're more interested in providing a quote that's going to make sense for them than to necessarily win the day. And so 2 years ago, when Eric and I were out securing debt, we would have 8 or 10 very compelling quotes. And I would say today, you're going to have 1 to 5 lenders that have very interesting terms that may include 10 to 30% depository terms in addition to the
You're talking about for a construction loan, maybe 10 to 30% of the
a regular loan, of a permanent loan, not a construction.
With the bank. With the bank,
yeah. And they're not afraid to ask for it, plus the operating account, which is very different than where we were 6 or 12 months ago. With that all being said, we are getting on any given request 1.5% to 2% spread between the lowest interest rate and the highest interest rate, and then you have to look at everything that goes behind that. What's the leverage point? What's the LTV? What's the covenants? So we too are going. We're finding success in the credit unions. We're finding some success in banks, and you just have to be very creative.
Excellent. I'm going to have some people that are upset at me if I don't give a full 15 minutes to operating trends, because everybody's trying to figure out what the heck's going on. So We're gonna move right over to operating trends. So how have ECRIs held up in July and August? And tell us about the trends you're noticing also in your move-ins and move-outs since the end of the second quarter.
Sure, thank God for ECRIs, that's what's keeping us afloat right now. Our customers continue to be sticky. We continue to be able to give them outsized rent increases on a regular basis. And it's really become more about what have I got to do to acquire the customer? What do I got to spend? What do I got to offer? What do we got to do to get that customer to rent from us? Because we know once we get them in our system, we'll ultimately make back those concessions through ECRIs. Asking rates are down significantly. And if you look at the very interesting phenomenon, if you look at the pricing nationwide from all of the REITs, you can see that they had, say in April, May, very different thoughts on what starting rates should be. And now they all came to the same conclusion, which is they need to be a lot less. But it took them a long time to get there, with the exception of Extra Space. I don't know what tea leaves you guys were reading, Noah, but it's obvious in your pricing that along about May 15th or so, you led the way down, and it's continued to come down. I can't think of a single market that's not significantly more competitive now than it was 6 months ago. So I don't think any of those are particularly great for our business, but ECRIs are holding up nicely. Move-ins are down a couple percent. Move-outs are constant. The one thing that we can predict with almost perfect accuracy, it seems like, is move-outs. They just seem to remain incredibly consistent. I recently heard someone compare our business to the nursing home, not nursing home, but senior living, particularly when it comes to ECRIs. Once they get in and they get settled, you can keep raising their rent until they don't need it anymore. And when they don't need it anymore, it really doesn't matter what you do. And I think sometimes we're a little bit like this. And expenses, of course, are pushing.
So Chris, how long, we have to pitch this every day, right, to lenders, because the lenders look at the asking rent, they say, 20%, 30%, whatever the number is, and then they want to apply that across the board, right? And they say your NOI is not what it is today, it's going to be less in the future. So we talk about the ECRIs, we talk about the customer acquisition costs and then increasing the rents.
The in-place rents and the high occupancies.
Right. Yeah, so it's a constant battle with lenders just to get them to understand the whole concept that you just walked through. So the question now is, with the discounts up front being so much more significant than they have historically, how long does it now take to get the increasing the existing customer rents to the point where
one of the interesting things we've been able to deploy, and again, it's not because we're not all that smart, we just stole ideas from other folks, mostly from the old. Is the cadence of increase. And it used to be that you wait 6 or 7 months after someone moved in before they get an increase. Now it's more like 90 to 120 days. And then after that, it's more like every 10 months instead of every 12 months. And different things like that start to build the check back up.
But does it take longer now? So to get them, is it 24 months to get
I would say right now we don't really know.
Okay.
But I would tell you that over the long haul, it is an amazing phenomenon where you end up with a significant, and really what you have to look at is even if interest rates starting rates come down 3, 4, 5, 10%. If you can send out, 8, 9, 10, 12% increases, you catch up fairly quickly. And then if people actually stay for 2, 3, 4 years and you continue to do that, you more than make up on the back end to where you've got these really interesting, healthy, positive variances depending on where you stay there.
So as you develop this more, we need to get reports from you that we can show to lenders to help prove this theory out. That's what the industry needs.
Although I'll also tell you that lenders that used to just take our reports and just say, great, now we're under a lot more scrutiny. And they're really pushing us to justify, how our systems, our rates, our reports are, starting at et cetera, et cetera. So you can just feel the scrutiny that's out there.
Just
So-
something to leisure with.
Yeah, I want to hear you and Brian just briefly talk on ECRIs, and then Chris, you started moving to my next question about what recent changes have you made to your customer acquisition strategy, so I'd love to hear from all three of you on that.
Yeah, so if the self-storage has a superpower, it's ECRIs, right? And it's a huge thing. We all know what it is. We've never done, Extra Space has never done ECRIs at 90 days. Right? It has never been done. I don't know if you even tested that, to be honest with you. Seems a little early. The rate issue, and Chris brought it up, we're doing that to bring in customers, right? We're looking at that. We're not looking across the street at what our customers are charging. Well, that's a thing. It's not a huge lever in the model for us. We're looking at what our move-in and occupancies look like. And as that comes in, we're then modifying what our price is. Now, we're going to be changing what our rates are all the time, changes every day. And so as people look at it and say, you dropped your rates a lot, that's right, but what we're looking at mostly is our achieved rate. And so while you guys are looking at what's the asking rate out there, it's very different than what
We're
we're
answering the
inside.
lenders' questions about that, though.
That's right.
When it's 40% less than the in-place rate.
And people look at this and they say, okay, what is the, they scrape it, and they look at it, it's not really the truth as to what's going on inside the property.
Right.
And so we're looking at those achieved rates, and that's what matters the most. And then we're using that ECRI and we're pushing that up substantially. How long does it get there? I'm actually giving that out, but you're moving it up substantially.
Yeah.
We are doing more now in ECRI pushes as far as a percentage increase than we were doing before COVID, but we're not doing what we were doing during COVID. That was a time that was unprecedented, and we pulled back a little bit from that. So it's not nearly as high. There is still a little bit of a rent roll down from where the achieved in-place rates are to where you're getting people coming in, obviously. But occupancies are still strong. We finished at 94% in July, so we're still very strong. ECRIs are still holding very strong. Again, in COVID times, we were pushing ECRIs so much that we were seeing higher move-outs because of that. Every time we do an ECRI, we pulled back quite a few thousand people and tenants in that, so we don't give that out to check and see, are we off? Is a lot more people moving out than they are without the ECRI. And we've seen that during COVID, we were getting really, really high ECRIs. It was so elevated, but it was still worth it for the percentage that we were able to give out. We've since pulled that back a little bit, and we haven't given such high ones, and that's come back to kind of more moderate levels and more to where we feel it's custom. Where it still works and is palatable for the customer.
I think these CRIs are very important to talk to our lenders about and get them off of the street rents. And we talk about cheap rents. No, we show them the cheap rents, the actual rents of the occupied units, plus the street rents of the vacant units, and really try to explain to them that what the gross potential is, and that the existing customers are sticky and we have potential to increase those rents, and really try to get them off of the street rents and more onto what you're really achieving.
Excellent.
So one other thing about ECRIs really quick.
Just one second. We have less than 10 minutes.